All right, we'll get this started as we like to keep it on track. But welcome. I'm David Levy, one of the partners and certified financial planners here at Diversified, and I have with me our Chief Investment Officer, Mike Horwath. As many of you have joined us in the past for these, we look to keep them about 30 minutes, and really enjoy doing these to keep you informed on what's going on in the markets at Diversified, what we're thinking about, what we're seeing, what we're doing. Everyone is muted, so if you have any questions, please enter them in the question box, and I will make sure, try to make sure that there's time at the end here to cover them, and if appropriate, dabble in here while Mike's chatting with them. But with that said, welcome. Thank you for joining. And I will turn it over to Mike to share some information with us today.
Awesome. Thanks, David. Welcome, everybody. As we always do, this is our quarterly market update, market and economic update. Just in terms of cadence, so everybody knows what the expectation is. We always do this one, usually about a week after quarter end. We like to do a webinar just to get everybody together, and there will be a replay if you do want to watch anything after the recording here. We'll also be sending out a quarterly newsletter. So we do a newsletter on a quarterly basis, a lot of similar content, just a little bit more written out, just I can expand more in written format a lot of times. And for those who like to read, see more graphics, do it at your own pace, just know that that'll be coming out in the next week. It'll be our quarterly newsletter from an investment standpoint that we like to do. So let's just jump on in. So from it's hard to believe the first 6 months are already done, but it was an interesting first 6 months. We saw a lot of things. There's been some reversal from what we saw in the first quarter. Really the main themes, if you will, and titling the newsletter really is a conflicting world, especially from an economic and market standpoint. Economics are kind of saying one thing, markets are kind of saying another, and they're not perfectly conflicted, but there is some confliction there. And the main themes we've seen, though, disinflation has really been alive and well. So disinflation means that inflation is rising, but rising at a slowing pace. So what we're seeing is inflation starting to come down, the Fed's higher rates taking hold. And I think some of it's also just natural. There's some things that coming out of the pandemic we're just going to take time to work their way through. But the key is the Fed has been raising rates to slow the pace of inflation, and that's been happening. We're above the 2% target. We'll talk a little bit about where we stand today, but inflation's coming down, and that's a good thing. Just in general, that is a good thing because there are ripple effects, especially with relation to the Fed, as to kind of what inflation means for the economy and what it means for things that kind of stem from inflation. The Fed finally paused. So for the better part of 18 months, the Fed has been raising interest rates. So what we've seen over the course of the last 18 months is interest rates, the Fed funds rate, right? The short-term rate has gone from really 0 all the way up to 5%. And they always show it as a range. So when it says 0%, the range is 0 to 0.25. And today it's 5 to 5.25. But we've seen 500 basis points, 5% of short-term interest rate increases. And the question now becomes, are they done? Will they continue to raise? Or is it time for them to cut? So this is really kind of it's been really one of the biggest dynamics in the market has been this constant repricing of what that expectation is. Is the Fed done? Is there a little bit more to go? And is there the possibility of rate cuts this year? So we'll dive into that a little bit. You may have already forgotten, but back in February and March, we also had this banking crisis where several banks completely went out of business. I think it clearly rattled markets at the time. We saw markets begin to expect rate cuts later this year because of it. Well, a lot of that has kind of fallen away, and now the banking system, which largely was fine, but it was the small regional banks that have come under pressure. We'll see what happens in the second half of this year, but by and large, that has mostly kind of gone to the wayside. And then kind of one of the biggest things has been the earnings and corporate profits and profit margins in the first half of the year, we've seen Q1 earnings really remain strong. We've seen profit margins largely remain strong as well. Margins have come down a little bit, but by and large, they've remained pretty steady. The question is, can corporations continue to see top line revenue growth? We'll see. One thing they have been good at is the bottom line, cutting costs. Some of that was, the layoffs within the tech sector. We've been able to see, corporates keep the profit margins largely intact. A lot of that will drive, what we're seeing markets, especially equity markets, moving forward. But there hasn't been this pullback from an earnings perspective or this shrinking of profit margins so far this year. On the right hand side of the screen, I just wanted to point out, this is the Atlanta Fed. What they do is they do what's called GDP Now, and they do a real-time estimate of what they expect the current quarter GDP to come out as. And the good news is, you can see it in the green bar. GDP Now is showing that roughly 2% on an annualized basis for Q2 GDP. So while economic growth isn't crazy strong, it has remained pretty resilient. You can see, and this is kind of this confliction of consumer sentiment's horrible. You can see the blue shade, even from an analyst perspective, a lot of the ranges of expectations are much lower than what the Fed, or at least the Atlanta Fed's GDP Now tracker, is showing as GDP growth estimates for the second quarter. We'll see how that projects as actual figures come out, but it's something certainly that's optimistic moving forward. When we look at what's going on from an asset class perspective, most of you know that equity markets have largely bounced back strong. If you remember 2022, both equity and fixed income had a rough year. Equities down close to 20%. Fixed income, worst really calendar year in history, down about 13% for investment grade fixed income. Both have largely bounced back. So financial assets on the stock side up almost 14% globally. US up, call it a little over 16, at least in US large cap. Small cap has lagged. International, while it started strong, kind of sputtered a little bit here in the second quarter, but global stocks up about 14% year to date, whereas investment grade bonds have been anywhere in that 1 to 3-ish% range this year. We saw them land at the end of June right around 2%. So financial conditions have, at least for markets, have bounced back well. And a lot of this ties back to a couple different things. One, this AI conversation has been interesting, but two, it's been earnings being strong, GDP growth hanging in there, inflation coming down, and the Fed finally pausing. All of these things have come together to put a backdrop where financial markets have largely moved past the shakiness that people are concerned from an economic standpoint to giving decent returns, especially coming off of 2022 that was concerning for many investors. So let's go to inflation, because inflation is important. Inflation is going to drive what the Fed does, and what the Fed does is going to drive a lot of sentiment, a lot of demand. So from an inflationary perspective, there has been decent progress made. We saw core CPI, so consumer price index, come down from 6.6 where it peaked last September to 5.3% in May. The June CPI numbers will come out next week, so keep an eye out for that. We'll certainly report that to you when we have those figures. But we've gone from 6.6 to 5.3 in core CPI. Core CPI does not include energy and food. Headline CPI is the full market, which does include energy and food. And those of you who have looked at energy prices have come down sizably. Oil sitting right around $70 a barrel. And food prices have also come down. And headline, which was up around 9.1 in the middle of 2022, has come down to 4.1% through May. Latest projections we've seen is that will likely come down into the high threes come the July and August reports, with energy, as long as it stays right around where it's at today. The challenge is that the Fed's target is 2%. So we're still above that, but we've been given enough optimism to see that clearly these numbers are coming down. Clearly higher rates and just the markets in general have been pricing in and working through the inflationary battle, and we're working our way towards target. Will we get to 2% this year? Highly unlikely in either scenario, whether it be core or headline. But the Fed's not going to need to see it at 2% this year to stop raising rates or even potentially cutting rates. What they want to see, though, is continued disinflation. And really, the conversation turns to what is holding up core CPI from continuing to fall down, and will it change course moving forward? I'll be including this in our newsletter, but if you look at core CPI and what the biggest challenges have been, it's really twofold. One is transportation, and two is shelter, right? Those are broad category names, but at the end of the day, it's the housing prices along with owner's equivalent rent. Housing prices and rent have been pretty high, right? And they have continued to move higher. What we have seen, though, in the way the methodology is calculated is that those should be coming down. They are coming down. And as they start to get factored into the inflationary system, it'll start to reflect lower and lower, and it will be contributing to lower inflationary numbers. On the transportation front, what you saw was, it's not necessarily that auto prices had risen so much. It was that auto prices risen, and in turn, auto repair and auto insurance had gone up because of higher car prices. Well, now you're starting to see car prices come down, and in turn, you're likely to start to see auto insurance and auto repair prices come down as well. Those two things, when you look at the world outside of energy and food, which are very volatile, will start to contribute in the second half of the year, and we'll continue to see. The question is, how quickly will it happen, and is the Fed going to be content with those numbers as long as they are above 2%? But progress has clearly been made, and we have a couple areas that we need to focus on. If you look at CPI and PCE, this is core CPI and core PCE. One's the consumer price index. One is the personal consumption expenditures index. They're just two different ways of measuring inflation, right? The blue is CPI, the purple is PCE. Essentially, they're trying to measure very similar things. They just have different methodologies. But these are overlaid. You can see the 2% target in red, and then you can see the blue as CPI and the purple as PCE. The main theme I want you to take away from this is clearly this has peaked and it is methodically coming down. We just have to keep seeing it come down to that 2% target to get kind of where we want to be for the Fed to be content. And really, as consumers see inflation back down to that 2% number, we do expect it to get there. It's likely into 2024. It could be most of 2024 until we get to that 2% number. But just know we're working our way down, and higher rates are helping, along with just other systematic items like just used car prices, new car prices, inventories, all of that working its way through. And it's not just the car prices, it is those ancillary things that stem off of autos that are so important. So that's what we've seen over the course of really the last 6-12 months, has been this change and this slow methodical drop. Because of inflation being so high, nobody should be surprised by this. The gray bar being at the end of 21, it's kind of still crazy to see this, and how quickly the green line, December 22, the complete inversion of the yield curve, right? Interest rates have completely changed over the course of a year. Just to slow the pace of inflation, the Fed had to, on the short end of the curve, raise rates very, very quickly. What we've seen this year is the short end as well had moved up a little bit, but really anything from 5 years on hasn't really moved. It's really just been on the short end where a couple more interest rate hikes from the Fed has driven up the short end of the curve. This is what people refer to as an inverted yield curve, where the short end, so short-term yields, are out yielding long end yields. All right, it's not a very common phenomenon in the sense that it's not a normal day-to-day thing that we would see this, but it typically happens when inflation picks up, when the Fed has to raise rates. It often precedes recessionary environments. It's not perfect, but that's often the case, because when you think about what has to happen, inflation picks up, the Fed raises rates, it slows the economy, and it goes into a little bit of a recession. Could be a deep one, could be a shallow one. Recession is just a broad term, but what we've seen is that the short-term rates have clearly moved up quite quickly over the course of the last 12 to 18 months. We often get the question, when are rates coming down? So the Fed has set the expectation that they believe their long-term neutral interest rate is 2.5%. So today it's 5. Not that long ago, it was 0. They believe that their neutral interest rate is 2.5%. Their expectations, which you can always take them with a grain of salt because so much can change day to day, is that we get there by the end of 2025. So their belief is that between now and 2025, they will cut rates, call it half, to about 2.5%. We'll see if that actually comes to fruition. A lot of it will depend on economic conditions, which is growth and unemployment, but it's also inflation, right? These things all work together. What I wanted to show is earlier this year, markets started to price in the potential or the belief that the Fed was going to cut rates in 2023. Our stance had been at the time, and still is, that it's just unlikely. Not that it can't happen, but that is just unlikely that they'll start to cut rates in 2023, and that you're probably looking at early to mid 24 before that makes sense. And why is that? Well, this graph shows the combination of inflation and unemployment, right? That is the dual mandate of the Fed. Keep unemployment nice and low, call it 4-ish%. Keep inflation positive below 2%. What we see today is we still see a very attractive and very strong employment market. Unemployment's still 3.7%, and you see inflation running higher than they wanted. The Fed has never cut rates at these conditions, right? And I think if you take a step back and ask yourself, why would they cut rates? There's just no reason for them to cut rates yet. Ultimately, what would need to happen is either CPI needs to come down, inflation needs to come down, or unemployment needs to tick up. So historically, we've seen the Fed cut rates when there was still a strong employment market. You think back to 2019, you can see it on the graph, unemployment was still under 4%. The difference is that inflation was kind of non-existent. It was still at 2%. And we've seen the Fed cut rates back in the 80s when inflation was still nearly double digits, and at times double digits. The difference was that unemployment had grown incredibly above 7%. That's a different market than what we're seeing today. Today we see inflation still too high, but unemployment still too strong. So there's just no reason for them to cut rates yet. What will happen over the next 6 to 12 months is going to determine when they start to cut rates. Either inflation comes down where they want it, and they can methodically cut rates, or something from an economic perspective, either slowing growth or unemployment picking up, drives them cutting rates. We're not there yet. We don't see them getting there, at least in the next 3, 4, 5 months. In fact, our belief is that the Fed will likely raise rates here in July, and we may have one more then again after that this year. So they skipped June, but it's likely that they'll probably raise rates, and this is what the market's starting to price in already, another 25 basis points here in July. So what's going on in equity markets? Look, I mentioned it earlier, equity markets have shined so far this year, coming off a year where they were down 20%. Things have largely rebounded. And you can see on the right-hand side, it's a lot of it's driven on earnings, right? There are certainly multiple factors here, one being inflation coming down and less concern over markedly higher rates. So that's one positive. Also, this AI conversation, now expectations for AI being able to drive not only growth, maybe help with bottom line profitability, but you've seen earning expectations remain pretty steady. But the good part is equity earnings have remained largely strong, and there were quite a bit of outperformances there in Q1. One thing you'll hear a lot of is how narrow the breadth has been, though. We want to see the market start to reward more than just the top 10 companies in the S&P 500. If you look at what is driving markets, it's the top 10 names. So it has been a very, very narrow leadership of markets. In order for this rally or this continued strength of equity markets to continue, you need to see that broaden out. We do think we'll start to see it. The question is, can those top 10 names, which are trading pretty expensively, and they're starting to become a lower and lower percentage of the earnings of the S&P 500, can that kind of continue? We'll see, but it's been a very narrow market. But fortunately, by and large, just from an index level, earnings have been pretty strong. On the bond side, I'm writing up a little bit of this in the newsletter. Is it time to add duration? We get this question all the time about, hey, CDs are paying me 5.5%, or my high yield savings is paying me 4.5%. Why would I go out beyond that within bond markets? And I think there's a few reasons why. One, diversification, right? When equity markets zig, bond markets are supposed to zag, not including 2022. That was certainly an odd year, just given what drove the volatility in markets. But in normal markets, bond markets provide you diversification. Here's the thing. Short-term cash often doesn't really diversify you as well as traditional treasuries, investment-grade corporates, high-quality mortgage-backed securities, things like that, that are just very high-quality investment-grade bonds. They protect you better, and not only do they hold their value, they are often positive when equity markets are negative. They add that diversification. There's also this reinvestment risk as a second issue. As rates drop, right, which we can agree that over the next 2 years, rates will drop, cash will immediately start to reflect lower and lower rates. The nice part about fixed income is as you start to extend into 3, 4, 5, 6, 7 year fixed income tools, you are locking in those rates for longer and longer periods of time. So as rates drop, not only are you locked in, the securities that you hold as bond yields drop, you'll start to actually gain value. It's the exact opposite of what happened in 2022. There is benefits there of not having to worry about reinvesting your proceeds. If you invest in a 12-month CD, the problem is if in 12 months rates are now substantially lower, you have to reinvest that into something that is substantially lower. So you just have to be cautious. Not that you shouldn't own short-term instruments, just be careful. And I think it makes a lot of sense to add duration, especially for the third reason, right? It's not always perfect, right? And past performance does not always equal future results. We all know that disclosure. But if you look historically at when rates had peaked or CD rates had peaked, for the subsequent 12 months, in all 12 periods, you can see them on the screen on the right-hand side, treasuries and investment-grade corporate bonds have really outperformed over every period for two reasons, right? It's not only are they yielding something higher and more substantial, but now if and when rates do get cut, because they often do get cut, they'll get capital appreciation from it as well. It is time to add duration. This is something that we're doing in your portfolios, is kind of adding duration to fixed income because higher rates are less of a concern at this point than they were not that long ago. This is just a reminder, right? It's also important to remember from a bond perspective, yields are substantially better than they were simply 10 years ago. If you look at even just investment grade yields, all of a sudden 5% is a pretty standard yield within the investment grade world. And you start getting down into the worst credit quality, right? We're not advocating of taking a ton of credit risk, but you can start to see double-digit yields. It's a better yield environment. This isn't late 2019 where yields were much different, or late 21 where yields were extremely low. We're now getting better yields. We're being compensated to own high-quality fixed income. Certainly what we want to see from our fixed income portfolios as we move forward. So just kind of outlook where we're going. I think really the focus is going to be on consumer spending and earnings. It probably warrants a separate discussion, but the consumer has remained strong. Can they continue to remain strong? The concern we have is if you look at consumer savings, it has come down markedly. If you look at consumer credit, it is increasing. Can they continue to spend at the levels they have? That's going to be a big driver of equity markets and really just corporate earnings. But economic data is something we're going to keep an eye on. Can the growth in the first half continue into the second half of the year? But we spoke about it a ton. Inflation is going to drive so much because it drives what the Fed is doing. So we're going to keep an eye on both inflation, unemployment. Keep an eye out next week for the June CPI numbers, which we think will be pretty optimistic, right? It'll continue this path of inflation coming down, which I think markets will at least respond pretty well to, barring any unforeseen surprises coming out of that. From a positioning standpoint, we're still a little bit defensive in our approach, especially in fixed income. You are being compensated, you saw on the previous screen, in investment grade bonds. So we are more defensive, especially within fixed income. But in the US, we're overweight, or in equities, we're overweight US over international. The dollar still has remained pretty strong. It has weakened, but that has stopped. Unless, I should say, when the dollar continues to weaken, we'll continue to add to international, as we'll see that as a tailwind for international. But for now, US, more mature companies, you can be more defensive here in the US. We do have tactical allocations to semiconductors, which has been a great spot to be. We've held that for some time now. And communication services, that sector we've added to more recently. But within fixed income, our focus is still at the top of the capital structure. Investment grade bonds are paying you pretty well. You get the equity market diversification, and that's what we're going to be focused on until we start to see the below investment grade stuff, what you call high yield bonds or junk bonds. Until we feel like we're being compensated to take that excess risk, we just don't see the benefit at this point. So David, I took most of the time, but I wanted to make sure that there weren't any questions here that I could answer while we're going through it.
Yeah, thank you, Mike. Actually, there is not, but I'll pose one to you. It's in regards to the debt ceiling, right? I know there was a lot of energy around the debt ceiling and nervousness. Can you touch on sort of where we stand, and that, I mean, you and I both know it's not gone, but like, what's your expectation over the next minute or two here? Share your thoughts on that.
No, it's a great question. Thanks for bringing it up. And I actually wrote about this in the upcoming newsletter on the very end. So there'll be a little note there, because it's a great point to bring up, because it kind of came and went quickly, right? There was so much buildup in May to what happens if the U.S. defaults. What do we do? Do we need to run? Do we need to do this? And our opinion was, look, it's a very, very low probability event, and we wouldn't do anything. Right, markets will respond pretty well. They won't take off. They'll respond well, though, to that risk being off the table. My point is, don't forget this the next time it comes up, because it will come up soon. There's a graphic you can see the projections of U.S. Debt. It's still going up. U.S. debt expectations aren't going down. So this will come around again.
When are you thinking?
I think you're still probably a good 18-24 months away from it probably being a realistic issue. The Treasury, once again, will do whatever they can to keep pushing that time frame out. But at some point, decisions have to be made. And what we've seen, if you look at the numbers, the U.S. Treasury will tell you they've raised the debt ceiling or modified it or changed the definition close to 70 times over the course of the last 50, 60 years. There's been a lot of, the difference is that it is so much more politicized today than what it was even a decade ago, and it will come around. Our advice at the time will likely be the same thing, right? The U.S. defaulting on its debt is a very low probability event, but markets, it's going to be a headline risk. It's going to be a challenge, I think, for investors, just at least to remain calm. But our advice will be the same. And our recommendation is, look, expect it to be in 18 to 24 months. Know it's going to be highly politicized. Know you're going to see scary headlines, and just know we're going to probably say the same thing, because that's just what we do and how we approach it. And
it's the right approach.
Yep. So I think that's what my expectation would be, and what we would suggest for investors to, just from an expectation perspective.
Excellent. Thank you, Mike. Thanks for the information today. For everyone, we will be sharing this as we normally do. And we'll continue to share all of our investment thoughts and outlook moving forward, whether it's the newsletter that Mike talked about that'll be coming out any day now, and we do the Monday market update and the monthly investment video. I actually listened to that on my way to work today. Good job, Mike. But anyway, I digress. Thank you everyone for joining. Have a great day, and we'll see you again soon.